In this segment of the Continuous Disclosure 101 series, we'll be discussing business acquisition reports, more commonly known as BARs. We will begin by discussing what a BAR is, including the specific elements that need to be considered in determining whether continuous disclosure filing is required, such as what constitutes a business under securities legislation and how to determine whether an acquisition is significant. We'll conclude by discussing what information needs to be included in a BAR filing and what the associated filing deadlines are. This video will focus only on the requirements related to BAR filings, but it is worth noting that completing a significant acquisition may also trigger other continuous disclosure filings, such as a news release, a material change report, and/or specific disclosure in an issuer's annual and interim filings. Please refer to the other videos in this series specific to those continuous disclosure documents. As a general reminder, the videos included as part of this series are intended to only be a general introduction to each topic and are focused solely on the requirements under Alberta's securities legislation. We remind issuers that the securities exchange that they are listed on may have their own policies and rules regarding acquisitions. We encourage issuers to seek legal advice with respect to their specific circumstances. In addition, the views expressed in this presentation are those of the presenter and may not represent those of the ASC, other securities regulators in Canada, or other staff. Let's begin by discussing what a business acquisition report is and why it is an important piece of continuous disclosure. A BAR is a standardized report that must be filed when an issuer completes a significant acquisition of a business. It provides important information to stakeholders on the business that has been acquired and the effect of the acquisition on the issuer. It also provides historical financial information for the business acquired and, in some cases, pro forma financial information for the combined entity. On the next few slides, we'll dive into more detail on what constitutes a business, how to determine whether the acquisition is significant enough to trigger a BAR filing, and what information is required to be included in the report. For clarity, these requirements do not apply in the case of a reverse takeover transaction. The first step in determining whether a BAR filing is required is determining whether the acquisition was that of a business or of assets. A BAR filing is only required in circumstances where a business is acquired, not for asset acquisitions. It's important that when making this assessment, you consider the specific facts and circumstances involved in the transaction. As a rule of thumb, we generally consider that an acquisition involving a separate entity, a subsidiary, or a division of a company is a business, and in some circumstances, a smaller component of a company may also be considered a business. When completing this assessment, you should consider the continuity of business operations. If the revenue-producing activity or potential revenue-producing activity will remain the same after the transfer, this would support the conclusion that a business is being acquired. It's important that you consider what exactly is being transferred. If items such as the physical facilities, employees, marketing systems, sales force, customer list, operating agreements, production techniques, or trade names are being transferred, this too would support the conclusion that it's an acquisition of a business. Finally, it's important to note that what may be considered an acquisition of a business for securities legislation purposes will not always align with the definition of a business for accounting purposes. So to ensure compliance, it's important that this assessment is done independent of the accounting assessment. Next, we'll touch on a couple industry-specific scenarios, as securities legislation provides more specific guidance for these acquisition types. The first scenario is specific to the acquisition of an oil and gas interest. National Instrument 51-102 specifies that if the acquisition is that of an oil and gas property to which reserves have been attributed, then it constitutes a business. The second scenario addressed is an acquisition of a mining claim. The companion policy to National Instrument 51-102 states that if the three criteria outlined in the companion policy are met, then we would not consider the acquisition of mining assets to be the acquisition of a business. First, the transaction would have to be an arm's length transaction. Second, no other assets would be transferred or liabilities assumed. And finally, there could not have been any exploration, development, or production on the claim in the 2 years prior to the acquisition. After you have determined whether there has been an acquisition of a business, an assessment needs to be done to determine whether the acquisition is significant enough to require filing a BAR. As you will note, the tests and thresholds are different depending on whether the reporting issuer is a venture or non-venture issuer as at the date of the acquisition. As shown on the slide, securities legislation outlines 3 separate tests that must be done to perform a significance assessment. Each of these tests should be completed using the issuer's most recent audited annual financial statements for the period that ended before the acquisition date. The asset test considers the issuer's proportionate share of the consolidated assets of the business or the related businesses by comparing the value of the acquired assets to the issuer's total assets. The investment test considers the issuer's investment in and advances to the business or related business in relation to their total assets, excluding any prior investments in and advances to the business. And the profit or loss test looks at the specified profit or loss of the business being acquired in comparison to the specified profit or loss of the issuer. For clarity, specified profit or loss is defined as the profit or loss from continuing operations attributable to owners of the parent, adjusted to exclude income taxes. For a non-venture issuer, the acquisition is considered to be significant if at least 2 of the 3 significant tests are triggered at the 30% threshold. And for a venture issuer, the acquisition is considered to be significant if at least 1 of either the asset test or the investment test surpasses the 100% threshold. Venture issuers don't need to apply the profit or loss test. It's worth noting that in addition to the significant tests presented on the slide, there are also a number of optional significant tests or variations that apply to certain scenarios. These include special situations, such as when audited annual financial statements are not available, an acquisition or business combination occurred in stages, the issuer and the acquired business's year ends are different, when acquisitions were made of related businesses, or when a loss has occurred or the issuer recorded lower than average profit or loss for the period being used. These special situations are beyond the scope of this introductory presentation and are covered in more detail in Section 8.3 of National Instrument 51-102 and the associated sections of the companion policy. One final note here related to an acquisition of an interest in an oil and gas property. In certain instances, as set out in Section 8.10 of National Instrument 51-102, the asset test does not apply. Once you've determined that the acquisition will require a BAR filing, the applicable form required to be filed is Form 51-102 F4. This form requires you to describe the nature of the business acquired, the acquisition date, the consideration paid, both monetary, non-monetary, and any potential contingent consideration, as well as the source of funds being used for the acquisition, and if applicable, a description of any financing being obtained. The effect that the acquisition may have on the financial position of the company, such as any plans or proposals for material changes that may have a significant effect on the company's financial performance or position. Examples may include proposals to liquidate the business or sell a substantial part of its assets, or changes in corporate structure, management, or personnel. Details of any prior valuation opinions that were completed in the last 12 months to support the consideration that was paid. Who the parties to the transaction were, including their relationship to your company, if any. And finally, financial information, which may include comparative annual financial statements, comparative interim financial statements, and for non-venture issuers, pro forma financial statements. Where comparative annual financial statements are included, the most recently completed financial period must be audited. To ensure this information is available by the BAR due date, issuers are encouraged to consider these disclosure requirements early in the transaction process. Additionally, for acquisitions of oil and gas interests, an issuer may opt to provide operating statements instead of financial statements if certain criteria are met. We recommend that issuers refer to the detailed guidance in Part 8 of National Instrument 51-102 to determine what financial information needs to be filed, as it varies based on the particulars of the acquisition. Now that we have discussed in what scenarios a BAR is required to be filed and what must be included in the BAR, we will discuss when the BAR needs to be filed. In most cases, a BAR is required to be filed on SEDAR+ within 75 days after the acquisition date for both a venture and non-venture issuer. However, securities legislation provides an exception to this rule in scenarios where the acquisition closed 45 days or less after the issuer's year end. In these scenarios, the deadline is extended to 90 days for a non-venture issuer and 120 days for a venture issuer. This concludes our overview of business acquisition reporting, which forms part of the Continuous Disclosure 101 series. Other videos in this series can be found on asc.ca. If you have any questions, please do not hesitate to reach out to the contacts listed on that page.